Hello. You're listening to No Se Habla Taxes, the podcast for creative agency owners who want to understand the financial side of their business without drowning in spreadsheets. I'm Melissa Armstrong, CPA and fractional controller, and every episode I give you real talk about the money stuff nobody explains clearly enough. Let's dive in. I want to tell you about a founder I worked with. Her name is Crystal. Crystal runs a marketing agency. She's good at what she does. Her clients like her, and for a few years, everything felt pretty manageable. Then the business hit about 700,000 in revenue, and things started to feel off. Not broken exactly, just harder than they used to be. More things falling through the cracks, more moments where Crystal wasn't totally sure who was supposed to be doing what. Her bookkeeper was sending her reports every month, and Crystal was looking at them and sort of nodding, but not really understanding what she was looking at or what to do with the information. And here's the thing Crystal kept saying to me: I feel like I'm doing everything the same way I always have, and it's just not working anymore. That right there, that sentence told me everything I needed to know. I have heard some version of this from almost every founder I've worked with at a certain stage of growth. And I want to say something about it very clearly. You are not doing anything wrong. You didn't miss something obvious. What's happening to you happens to almost everyone who builds a business past a certain point, and there's actually a really logical reason for it. That's what we're going to talk about in this episode. Let's talk about why systems break during growth. And here's the thing about financial systems and really business systems in general. They are built for the business that you have at the time you build them. When you're a solo founder or running a very small team, you probably don't have formal systems at all. You have habits. You have a way of doing things that lives mostly in your head. You know where everything is. You can keep track of who owes you money, what your expenses look like, roughly what's coming in and going out. And it works because the business is small and small enough that one person can hold it all together. And then you grow. Yay. You hire people. You take on more clients. You have more revenue moving through the business. And suddenly, the thing that worked before, your habits, your informal processes, your mental model of where everything stands, it just can't hold the weight anymore. It's not that you outgrew your systems. In most cases, you never really had systems. You had workarounds that felt like systems because the stakes were a lot lower. And I want to be really clear that it is something completely normal. That is how almost every founder led business starts. You don't build infrastructure for a business you don't have yet, because that would be weird. You solve the problems in front of you with the resources you have, and you move accordingly. The issue is that growth creates complexity faster than most founders expect. And complexity doesn't give you a heads up, it just arrives. All right. So, where do things tend to break, and what exactly breaks first? There are a few moments in a growing agency where the financial cracks tend to show up more clearly. I want to walk through them because naming them helps. The first one is usually somewhere around the point where you make your first or second real hire. Suddenly, money is leaving your account on a predictable schedule in a way that it wasn't before. Payroll is not forgiving. It doesn't care that a client paid late. And a lot of founders hit this moment and realize they don't actually have a reliable picture of their cash flow. They've been operating on vibes and checking their bank balance. The second inflection point tends to come when you're managing multiple client engagements simultaneously. and you start losing track of which ones are actually making you money. You're busy, revenue looks okay, but at the end of a quarter, you can't quite explain where the profit went. This is usually a sign that you don't have project level visibility. You know what came in, but you don't know what it cost you to deliver. The third is when you start delegating financial tasks to someone else, an admin, an ops person, whoever, and you realize there's no real process to hand off. Everything was living in your head, and now it's just unclear. And you either micromanage it because you're anxious, or you let go completely and hope for the best. Oof, neither one is great. Crystal was hitting all three of these, not at the same time, but in a pretty compressed window once her revenue started climbing. And what she was experiencing wasn't failure, it was friction from growth that her existing setup wasn't able to absorb. Let me break down what you actually need at each stage. I'm going to give you a rough framework here. These are not hard rules, and every business is different, and there's always exceptions. But as a general map, this is what I see. Under about 500K in revenue, the priority is clean books and basic cash flow visibility. You need to know what's coming in, what's going out, and roughly what you owe and what's owed to you. A good bookkeeper and a basic reconciliation process gets you most of the way there. The goal at this stage is accuracy, not sophistication. From about 500,000 to 2 million, the game changes. Now you need reporting that you can actually make decisions from. You need to know your margins, not just overall, but by client or by service type if you're able to get there. You need a financial close process that happens on a real schedule, not whenever someone gets around to it. You need cash flow visibility that goes out further than 2 weeks. This is a stage where having controller level support, someone who's building and managing these systems, starts to make a real difference. Over 2 million, you're dealing with more people, more complexity, more decisions that have real downstream consequences. You need financial infrastructure that can support a leadership team, not just a founder. That means cleaner internal reporting, clearer processes around approvals and spend, and ideally somebody who's thinking about your financial operations proactively rather than reactively. The mistake I see most often is founders trying to run $2 million operations on $5,000 infrastructure. You're not doing anything wrong. It's just that the scaffolding hasn't kept up with the building. So, what do you actually do with this? The good news is that catching this early or even catching it now after the friction has already started is not that hard to course correct. The problems that come from outgrowing financial systems are almost always fixable. They're not fun, but they are fixable. The first thing is just to get honest about where your gaps are. Not in a self-critical way, in a practical, diagnostic way. Where are you making financial decisions without the information you need? Where are you relying on something that lives only in your head? Where have you had a surprise, whether it's cash flow, a client cost, a tax bill, that wouldn't have been a surprise if you'd had better visibility? Those gaps are not character flaws. They're infrastructure gaps. And infrastructure gaps have infrastructure solutions. The second thing is to resist the urge to fix everything at once. That's a good way to fix nothing. Pick the most painful gap. That's usually cash flow visibility or project profitability. and build one thing that actually works before you move on to the next. Crystal, by the way, is doing fine. Once we identified what was actually broken, the fixes were pretty targeted. She didn't need to blow up everything she'd built. She needed to add some structure on top of it. And once she could actually see her numbers clearly, a lot of the stress she'd been carrying around just lifted. Because it turns out a lot of business anxiety lives in the gap between what you know and what you're guessing. Here's your homework. I want you to pick one financial decision you made in the last month that you wish you'd had better information for. Maybe it was a hiring decision. Maybe it was taking on a client that you weren't sure about. Maybe it was a cash flow moment that surprised you. Write it down. Then write down what information would have helped. And do you have a way to get that information right now, or is that a gap? That's it. One decision, one information gap. The exercise will point you pretty directly at where your financial infrastructure needs attention. Okay, here's a short version of everything that we just talked about. Financial systems break when you grow because you build them for a smaller business. That is normal and an exciting problem to have. It's not a sign that you're bad at this. It's a sign that you're growing, and growth requires you to update your infrastructure. The earlier you catch the gaps, the easier they are to fix. And the clearer your financial picture gets, the better every other decision in your business becomes. If you want help figuring out where your gaps actually are, we do a thing called No Se Habla Confusion Assessment. It's a 90-minute discovery call, an independent review of your books, and a follow-up with findings and a clear roadmap. $500 flat. Email info@steadyhandaccounting.com with the subject line No Se Habla Confusion, and we'll get you on the calendar. I'm Melissa Armstrong. Thanks for being here, and remember, no se habla taxes.